If you stay, I'll reveal the best smart money concepts guide on YouTube. Let's start with the order flow. Order flow refers to the external swing points of the market. These are the key turning points where price changes direction. To identify these swing points, you need to zoom out and look at the bigger picture. Start by picking a higher time frame. Now mark out the significant highs and lows on that chart. These are your external structure points. If you see that price is making lower highs and lower lows, then the order flow is bearish. This means that the big players in the market are actively pushing price down. If you see price making a series of higher highs and higher lows, then the order flow is bullish. In this case, the smart money are accumulating positions and driving the market up. Now, these big players don't just buy and sell randomly. They have specific intentions and goals in mind. This is where the concept of order flow comes in. By analyzing the external swing points, you can read the overall direction of the market. The key is to trade in the same direction as the order flow. Don't try to fight the trend or guess when the market will turn. Instead, focus on following the big players and riding the big waves they create. One of the best ways to analyze order flow is to look at multiple time frames. Each time frame gives you a different perspective on the market. The higher time frames show you the bigger picture, while the lower time frames show you the details. The external swing points on a lower time frame are often seen as internal structure on a higher time frame. This is why it's so important to look at multiple time frames when you read the market. For example, you might start by looking at the 4-hour chart to get a sense of the overall trend. If you see a series of lower highs and lower lows, you know the order flow is bearish. Then you can drop down to the 15-minute chart to look for specific entry points. On the 15-minute chart, you'll see smaller swings that are part of the bigger picture. These are called internal structure points. They're the building blocks of the larger trend. Thus, by comparing the 15-minute swings to the 4-hour trend, you can get a sense of how the market is behaving on a smaller scale. You then simply look for bearish setups on the 15-minute chart that align with the overall bearish order flow on the 4-hour chart. Trend is all about the direction of price over a specific period. It's the overall movement of the market. To identify the trend, you need to focus on the internal swing points on a lower time frame. Internal swing points are the smaller highs and lows that occur within a larger trend. If you see that price is making a series of higher highs and higher lows, then the trend is currently bullish. Each new high is higher than the previous one, and each new low is also higher than the one before. In a bullish trend, you'll often see strong, impulsive moves to the upside, followed by smaller, corrective moves to the downside. These corrections are typically short-lived and serve as opportunities for buyers to enter the market at a better price. On the flip side, if price is making a series of lower highs and lower lows, then the trend is bearish. In a bearish trend, you'll often see strong, impulsive moves to the downside, followed by smaller, corrective moves to the upside. These corrections are typically short-lived and serve as opportunities for sellers to enter the market at a better price. Now let's talk about fractal alignment and how it ties together the order flow and the trend. So order flow is the overall direction of the market, determined by the external swing points, the big picture view of where price is heading. Trend is the current phase of that direction, identified by the internal swing points. It's like zooming in on a specific part of the chart. Remember this, the internal direction, the trend, actually makes up the external direction, the order flow. It's like a fractal pattern, where the smaller parts contribute to the larger whole. To really understand this relationship, you need to assess order flow and trend in relation to each other. This is where multi-timeframe analysis comes into play. By looking at different time frames, you can see how the trend on a lower time frame fits into the overall order flow on a higher time frame. Let's say the order flow on the daily chart is bearish, making lower lows and lower highs. However, when we zoom into the 1-hour chart, we see that the current trend is actually making higher highs and higher lows. This is a common scenario that occurs when the order flow is pulling back. After a new low or high is established, price will often gravitate to collect more orders before continuing in the direction of the overall order flow. During this process, the trend on the lower time frame may differ from the higher time frame. As price navigates towards your points of interest, you need to wait for trend and order flow to align before entering the market. So it's all about looking for consistency between the time frames. If the order flow on the daily chart is bearish, you want to see the trend on the 1-hour chart also making lower lows and lower highs. If the trend on the 4-hour chart is bullish, you want to see the order flow on the 15-minute chart also making higher highs and higher lows. When trend and order flow are aligned, the market is more likely to continue in that direction. The next smart money concept is the break of structure. Looking at this price chart, you see a series of swing highs and swing lows. When price breaks above the most recent swing high and closes above it, this is a break of structure to the upside. It means that the old structure, which was defined by the previous swing high, has been broken. Price has now created a new structure with a new swing high in place. The same concept applies to the downside. If price breaks and closes below a swing low, it's a break of structure to the downside. The old structure has been broken and a new one has been created. A break of structure is viewed as a continuation sign. It tells you that the buyers or sellers have taken control and that price is likely to continue in the direction of the break. So to make it very clear, a break of structure is simply a break above a previous higher high in an uptrend, or a break below a lower low in a downtrend. The change of character is another important concept. When you're looking at this price chart, you see a market that has been in a downtrend for some time. Price has been steadily making lower highs and lower lows. And right here, price suddenly breaks above the previous major swing high. This is a significant event because it means that the buyers have finally gained the upper hand. They've managed to push price above a key level of resistance, and this could signal a potential trend reversal. This is what we call a change of character. It's a sudden and significant shift in the price action of the market. In this case, the change is from a bearish trend to a potentially bullish one. The key is to watch what happens next. If price continues to make new higher highs and higher lows, then we can say with confidence that we've transitioned into an uptrend. In an uptrend, a change of character would be signaled by a break below a previous major swing low. This would indicate that the sellers have taken control and that the trend may be reversing to the downside. If price continues to make new lower lows and lower highs, then we can say that we've transitioned into a downtrend. The premium and discount zones are very important in smart money trading. In this chart, the distance between a swing high and a swing low is called a price swing or a price wave. If you measure the distance from the top of the leg to the bottom and you apply a Fibonacci retracement, you can get the premium and discount range. In general, anything above the 50% mark of the price swing can be considered premium, and anything below the 50% mark can be considered discount. When price is trading in the premium area, it's like gravity is pulling it back down. There's a higher probability that the price will reverse and start moving lower. This means that selling in the premium area has a higher probability of success. When price is trading in the discount area, there's a higher probability that the price will reverse and start moving higher. This means that buying in the discount area has a higher probability of success. Of course, you won't use the premium and discount zones as a standalone strategy, but by combining them with the other concepts, you can start to build a more complete picture of the market. In this smart money approach, you will use the premium and discount concept to help you decide when to enter a trade. For example, if you're looking to go long, you might wait for price to pull back into a discount area before entering. If you're looking to go short, you might wait for price to rally into a premium area before entering. Supply and demand zones are one of the most important smart money concepts. When smart money want to open a position with a large volume, they can't just randomly place a huge order in the market. This would upset the balance of supply and demand and trigger their order at a worse price. This could seriously eat into their potential profits. Instead, banks split their large positions into smaller, more manageable blocks and place them at strategic levels in the market. These levels are known as supply and demand zones. A demand zone is located at the last down candle or series of down candles before price makes a big move upwards. This is where the big players are secretly accumulating their long positions, hoping to ride the wave of bullish momentum. When price comes back down to this demand zone, you often see a strong reaction. That's why demand zones act as strong support levels, where price is likely to bounce higher. A supply zone is located at the last up candle or series of up candles before price makes a big move downwards. This is where the big players are quietly unloading their positions, hoping to profit from a potential price drop. Supply zones act as strong resistance levels, where price is likely to stall or even reverse lower. In smart money world, you'll often hear the word mitigation. This term is related to supply and demand zones. Now, in this price chart, observe this new demand zone forming. Price started to rally higher from this zone. This is what we call an unmitigated demand zone. An unmitigated zone is like a magnet for price. It's an area that hasn't been visited before, and it's screaming out for attention. The big players who place their orders in this zone are eagerly waiting for price to come back and fill them. On the flip side, here we see a supply zone with a reaction. Price has come back to this level, touched it, and then fallen away. This is what we call a mitigated supply zone. A mitigated zone is an area that has been visited before. The sellers that place their sell orders at this level have already had their fill, and they are probably not interested in sticking around. This is important because knowing whether a zone is mitigated or unmitigated can give you clues about what price is likely to do next. If you see price approaching an unmitigated demand zone, you know that there are probably a lot of unfilled buy orders waiting there. This means that there's a good chance price will bounce off this level and start rallying higher. On the other hand, if you see price approaching a mitigated supply zone, you know that most of the sell orders have probably already been filled. This means that there's less resistance at this level, and price may be able to break through and continue falling. Fair value gaps are used to detect market imbalances or inefficiencies. These imbalances happen when there is significant buying or selling pressure. When you look at a chart, you'll notice that most of the time, the price tends to retrace and leave wicks on both sides of the candles. Sometimes you can see candles with no overlap on either side, which is what we call a fair value gap. The idea behind fair value gaps is that the market will eventually come back to these inefficiencies before continuing in the same direction as the initial strong move. This is similar to the principle of supply and demand trading. For a fair value gap to develop, there must be a set of 3 candles characterized by heavy buying or selling in the same direction. A gap will form between the first candle's higher wick and the last candle's lower wick. In this example, the price movement doesn't have a fair value gap, as the previous candle's high level balances out the low level of the third candle. This price action is considered to be balanced. Next, we need to talk about liquidity and inducement. In simple terms, liquidity is just another word for money. Liquidity refers to the amount of money flowing in and out of the market. Now, where does this money come from? It comes from orders placed by traders. And the big banks and institutions are paying close attention to where these orders are coming from. You see, banks use a simple strategy called inducement to lure unsuspecting traders into their traps. They'll create artificial setups in the market, making it look like there is a lot of demand for a particular market. And they do this by placing a bunch of orders in a specific area, creating what's known as a liquidity pool. They want to induce traders to activate their capital. In other words, they want you to place your orders in that area so they can take your money. Once the banks have lured in enough orders, they'll make their move. They'll start buying or selling in the opposite direction, taking out all the stop losses and freeing up positions for themselves. The banks don't want to fight for every move they make. They want to be able to initiate price in the direction they want without hitting any areas that could cause a battle. That's why they built these liquidity areas in the first place, by inducing one side of the market and then clearing out that liquidity. The banks give themselves all the buying or selling power they need to move price wherever they want it to go. Let's consider a trading range. Below the support level, there are stop-loss orders of buyers, and above the resistance level, there are stop-loss orders of sellers. When the market breaks below the support level, new sell trades are triggered by traders expecting a continuation of the breakout. A break above the resistance level activates new buy trades. So liquidity refers to the orders on both sides of the trading range. Buy-side liquidity represents new buy orders above the resistance level, accompanied by stop-loss orders of sellers. Sell-side liquidity is characterized by stop-loss orders of buyers below the support level, accompanied by new sell orders. By pushing the market above these levels, smart money can access the liquidity required to move price. So where else can you find liquidity? The obvious place to look is at previous swing highs and lows. These are areas where the market has reversed in the past, and they're often seen as key levels of support and resistance. Think about it like this. If the market has bounced off a certain price level multiple times in the past, there's a good chance that there are a lot of orders sitting at that level. Another place to look for liquidity is at equal highs and equal lows. These are areas where the price has reached the same level multiple times, creating a sort of line in the sand that traders are watching closely. If the price breaks through an equal high or a low, it could trigger a wave of pending orders and stop losses. That's why these levels are often seen as key battlegrounds between buyers and sellers. Trend lines are another great place to look for liquidity. These are diagonal lines that connect a series of highs or lows. If the price is bouncing off a trend line, there's a good chance that there are a lot of pending orders sitting just above or below that line. Chart patterns are another key area to watch for liquidity. These are specific formations that the price makes on the chart. Each of these patterns has its own unique characteristics, but they all have one thing in common. They are often seen as key levels where the market is likely to break out or reverse, and where there's a potential for a big move, there's usually a lot of liquidity sitting nearby. If this smart money guide helped you, you don't want to miss the next ones.